The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Hello, investors. Welcome to the Reckless Investor Show. I'm your host, Marquise Harding. And today, we're celebrating the 4th of July on the 1st. By the time this video comes out, it'll be the 4th. But everyone who's from America or who is American, happy 4th of July. So today, I have something special for you guys. A friend of mine requested 3 stocks, and I'm going to review them, find the fair value of these stocks, and what they are according to the clear picture, and find their gut check score. So, we're going to look at IBM, Starbucks, SSD or Simpson Manufacturing Company. So let's begin. So IBM has decreased their revenue growth over the past 5 years to 39.35%. So let me clear some stuff up. All these numbers are from this year compared to 5 years ago. So now the revenue growth is 39.35% lower than what it was 5 years ago. Profit growth is 22.33% lower than what it was 5 years ago. But however, it is 91.02%, about 91% higher profit margin, that is. Same thing with gross margin is about 49% higher, but net income is over 100% lower than where it was 5 years ago. It's funny, I'm just looking at it now, that all the main pillars of growth, like revenue, profit, and net income, is down. It's lower, but their margins for profit, growth, and net margin is higher. That's interesting, just looking at it right now. Their free cash flow is almost 28.25% lower where it was 5 years ago. But the price of free cash flow is 9.98, almost 10. To me, that means they're undervalued than what they were 5 years ago. The free cash flow yield is 10.29, versus 10.3%. That's good. You want that about 5. Their debt to free cash flow is great. It's 4.28. That means they can pay off their debt in less than 5 years. They're buying back 59 million shares, which gives you, they're adding about 6.6% more value to your shares. Their return on assets, because I changed return on invested capital to return on assets. To me, it seems like it's a better evaluation of profitability than return on invested capital. So return on assets is 5.98. You want that above 5. Pretty much what it is saying is how profitable are they on their assets. So IBM is a tech company. So that means their servers, their databases, their computers that they manufacture, how profitable are they on those? Then return on equity is simply the equity of, their net income divided by their shareholder equity. Or how profitable are their net income? And it's 42.82. So almost 43% profitable. So I have two discount cash flow models. One is one that Jacob Morris made that I have been using and I've been enjoying. Then another that I copied the format of Divinology and how he did it. I like this one too. So what I'm going to do from now on is compare the stocks with these both discount cash flow models and average out the fair value of both of them. But there will be stocks where one, for example, if Jacob Morrison's discount cash flow model was like way over fair valued, but his Divinologies, it seems like it's a fair value. I'm gonna just pick one, but both of these are about roughly about a good price range. But according to Jacobs, their fair value is $149.78, which is about a 6.08 upside to IBM. But according to Diviology's discount cash flow model, it's actually 138. So about a 2.06 downside. So let's look at what it comes out if I average both of them out. So the current price is $149.19 right now. The fair value of if I average both of them out would be $144.06. So an acceptable buy price with a margin of safety is $93.64. So I have about 2% upside right here. Well, let's do the gut check score. The gut check score of IBM is 1, 2, 3, 4, 5, 6, 7, 8, 9. It is a 9. 63.23. Alright. So, actually, I forgot to do something really quick. So, I have a fair value of 144. IBM's forecast, 27 analysts are reviewing IBM. And it said the high is 174, 146 the average, and 116 is the low. So mine's roughly by the average. And it actually is very close to a hold. But actually, let's look. Yeah. Alright, let's go to Starbucks. Hey everyone. So we're gonna look at Starbucks. Everyone know who Starbucks is? For those who don't know, Starbucks is a company that makes and sells coffee and other beverages to customers. So, it's a coffee company that sells coffee and other stuff. And I had a discussion about Starbucks in Ryan Williams' Discord message or Discord server about Starbucks. I want to apologize to those who are in that Discord server. I was talking about the ROE, how it was -7, but I saw I'd made a typo in my evaluation. I fixed it. It changed, but it still doesn't change my opinion about the stock. But let's go over Starbucks. So the revenue growth has gone up 26.65% from 5 years ago. Profit growth has gone up 36, almost 37%. Profit margin has gone up almost 54%. But the gross margin is about 33%. You want that above 40 to be a profitable gross margin. Net income has gone up 32.90, almost 33%. Net margin has gone up 87.27. Free cash flow has gone up 27.91. That's almost 28%. Here is where my opinion for Starbucks has surfaced. They are very, very overvalued. Price of free cash flow says it's $164.25. You want that between 15 and 20. So if that thing's over so for me personally, I'll let that thing go over 20 or go to 25. 25 is past 25 would be pushing overvalued territory. So in a sense, 26 and above, that's overvalued, in my opinion. But to have 164, that's extremely overvalued. That means this company needs to fall. That means they don't have really free cash flow to handle their debt, which we can see 2 slots down. After free cash flow yield is 4.53, you want that by over 5, but their debt to free cash flow. This goes hand in hand with the price to free cash flow. Is that for them to pay off their debt, it's going to take them about almost 38 years. They are buying back shares. 301 million shares. And they're providing you 25.38% more value to your shares. They are giving you return on their assets, 16.73. They are returning positive equity returns, 10, almost 11%. So here's one of those that I put in the numbers right here. Revenue growth, like a copy from here. It's saying 32.9 billion, 36.26% or billion. But it says it's 91 and 69. That I don't agree with how bad the price of free cash flow is and their debt level. I do not agree with the 91. That's one thing I do not agree. Yes, that's even with a 12.5% rate of return. I feel that's a little high. But here's another thing. We can look at the free cash flow of this one. It's so bouncy. I understand this is a fluke year with COVID. I understand that. And they made back, in a sense, 3,857% on their return on the free cash flow. See, like 2.7 billion to almost $1 trillion in revenue or free cash flow. Then back to 3.2. What the heck? What's going on? When you see a comma, even though it says 1,000, these are in millions. So it would technically be 9.9 billion. So how can we go from 2.7 billion to 9.9 billion, then drop all the way down to 3.2 billion? This wasn't even COVID. This is COVID. I'm based on this because it will give me a very outrageous number for their average growth rate. So I just made it the dividend yield, not dividend yield, for cash flow yield. And I got a fair value on this at 27.78, which is at 175% downside. But if you average this one and this one, it gives me a fair value target of 59.73. Right now it's selling for 76.39. An acceptable buy price of 38.83. A downside of 27.88. So almost 28% downside. To me, this feels more right. Just with our debt levels, that is where I draw the line of the price of Starbucks going up. I mean, it may. I don't really care if it goes up or down. They need to get their debt levels under control. So my target is 59.73. Starbucks forecast, according to analysts, is 142, 96, 29, and 65, 65. So mine's below their low. But yeah, you even look at the analyst consensus, it is slowly drifting to the hold category. But that's my opinion about Starbucks. I know many people are not going to like it, but it's my opinion. Take it or leave it. Alright, SSD. Let's go. Okay, SSD. They are in the building product sector of the industry. They're in the industry sector, the subsector of building products. So Simpson Manufacturing Company Incorporated, through its subsidiaries, design engineers, manufacturers, and sells wood and concrete construction products. The company offers wood construction products, including connectors, truss plates, fastening systems, fasteners, and shear wall, and prefabricated lateral systems to use in light frame construction and concrete construction products comprising adhesives, specialty chemicals, mechanical anchors, carbine drill bits, powder, actuate tools, fiber reinforced material, and other repair products for use. And use in concrete construction repair and strengthening and protection products. So they're like a company that provides parts for construction companies. They have markets in the United States, Canada, France, UK, Germany, Denmark, Switzerland, Portugal, Poland, Netherlands, Belgium, Spain, Sweden, Norway, Australia. Is that Australia? Yeah, Australia, New Zealand, China, Taiwan, and Vietnam. Their headquarters in Pleasanton, California. So, let's get to the review. Okay, so Simpson Manufacturing Company Incorporated has risen their revenue by 45.29 or 45.3%. Profit growth has risen 45.71. Profit margin has gone up 95.64, pretty much 96%. Gross margin 54.29%. Net income has gone up 66.32%. Net margin has gone up almost 87.5%. Free cash flow, which is good, has gone up 46.23%. Let me change it for a second. Price of free cash flow is 32.35. They're a little bit they're overvalued for one. They need to drop a little less than 6.5. Their free cash flow yield is kind of horrible. and EV over 5, there's a 37 point, not 37, 3.75%. Their debt to free cash flow. They can pay off their debt in less than a half a year. That's crazy. Shares outstanding, they're buying back 5 million shares, which is giving you about 11.63% more value to your shares. They're returning about almost 13% back on their assets, and also their equity. They were almost returning back 16%. So the current price is $1.61. $100.61. Sorry about that. I forgot to unclick my mic. We can see the high of 159, 144 the average, 124 the low. There is about 8 analysts on this. So here is an example of when Jacob Morrison's discount cash flow model goes haywire. This stock shouldn't be hit over 120 grand. So I'm pointing it out. Everything is right. They just don't make a lot of money. That simply is it. Everything's low. They just barely made 1.5 billion in revenue last full year. Revenues increasing, gross profits increasing, net income's increasing. They already have a lot of shares out. Even EPS is growing. There's no issue with the margins. All the ratios are fine. Really no debt to equity ratio, which is good because you want that under 1. Their debt to free cash flow is pretty much non-existent. Return on equity, assets, and invested capital is amazing. So yeah, they don't make a lot of money to really get a fair value from Jacobs Morgan discount cash flow. We now on Diviology's discount cash flow model, and I get a fair value of 108. That's below the low that they have set, and is approaching a strong buy. No analysts have said we need to hold or sell or strong buy or strong sell. Sorry. So I may look into this company as a potential holding. I do like the free cash flow growth, but I want to see the price of free cash flow down a little bit more. But it's time for the gut check score. I'm also going to do Starbucks. I completely forgot to do Starbucks. So they have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 84.62, and Starbucks 1, 2, 3, 4, 5, 6, 7, 8, 8, 9. So Starbucks is a 9. So IBM, Starbucks is a 9. Simpson Manufacturing Company is a 11. But if you guys have any stocks you guys want me to look at, let me know in the comments down below. And please subscribe if you like what you saw. Thank you. Take care. Bye, investors.